Well, joining us now to talk more about the possible economic fallout from the tariffs is Torsten Slok, chief economist at Apollo Global Management. Torsten, it's good to have you on. We just heard it from Dan Ives. He's talking about the idea that if these tariffs stay in place at these current levels, it's Armageddon in technology. How are you gaming this out right now, especially given the fact that, look at like Vietnam, for example, 46% tariff. I realize there's a transshipment argument to be made when it comes to something like China, but these are just huge numbers.
Yeah, because, Morgan, that's absolutely right. A very important part of this discussion is that 40% of the revenue in the S&P 500 companies comes from abroad. And for the tech companies, the Magnificent Seven, it's 50%. So there is a significant dependency, especially among the Magnificent Seven, on the rest of the world. So given that tariffs are having a bigger impact on the rest of the world, at least in GDP terms, than on the U.S., that does mean that there is some trouble, especially for the tech stocks, as a result of tariffs.
Has the risk of recession risen here in the last 24 hours?
Absolutely, because we already came into yesterday with negative corporate sentiment. CapEx planning among corporates in Fed surveys was showing that corporates were planning to do less CapEx over the next 6 months. For consumers, we saw sentiment decline, both for households making more than $100,000 and households making less than $100,000. And consumers also are more worried about their jobs. And consumers are also saying that business conditions in the next 12 months will be worse than what they have been at any point in the last 40 years. So the conclusion is that consumer sentiment has been weakening, corporate sentiment has been weakening, and now over the next several quarters, the most important thing that Navarro just said is that there is no negotiation. And if that is true, then we should plan that this will have negative implications for earnings for the S&P 500, again, especially for the Magnificent Seven over the next several quarters. So this does indeed raise the likelihood of a recession, especially combined with now more than a 10% sell-off in the S&P 500.
Well, Torsten, you just mentioned it. Let's hear it. Here's what Trump administration senior counselor Peter Navarro said about whether the tariffs are negotiable.
Let me make this very clear. This is not a negotiation. This is not that. This is a national emergency.
So with that in mind, Torsten, I'm looking ahead to the jobs report. And here's how I'm thinking of it. And I'm not an economist, so I'm looking for your insights and correction here. If it's a really good report, well, then maybe that helps folks imagine that the consumer can hold out for a while if there's some negotiation, despite what Navarro just said. If it's a really bad report, well, maybe that makes people think, well, the Fed has to cut because of that part of the mandate. But if it's just a mediocre to slightly bad report, might that be the worst scenario tomorrow for the market?
Well, I think this is a very important debate, John, because let's say that this number is good, meaning 150,000 jobs created in the month of March. Then the market will say, well, this is stale information because we just learned a few days ago about a significant increase coming in tariffs and therefore a significant negative hit to corporate earnings because of the required structural change for the U.S. economy. If, on the other hand, we do get a really bad number, then that tells us that, well, the numbers were bad even before the news of this week. So in that sense, it's a very asymmetric setup when it comes to the employment report for tomorrow. We've already seen, including today from the Challenger Gray and Christmas, that there's more layoffs, especially in the federal government. So the fear, of course, you can have is that slowly over the next several weeks and months, we will begin to see the unemployment rate begin to creep higher. And combining that with the decline in the stock market, negative sentiment for consumers, negative sentiment for corporates, and also the negative impact of tariffs on earnings, it does look like the picture here for the economy is like there's more downside risk going forward.